we have Zach Myers coming on from Wilson Sonsini Goodrich Rosati. Zach, I believe, is going to be popping in shortly. He's going to be giving a presentation about the trends of early stage venture capital investing and early growth startups. Zach himself is with Wilson Sonsini's San Diego office. His practice includes, corporate securities, M&A, and VC. And I think he has a background from some experience with Sempra Energy. So welcome, Zach.
Okay, well, thank you so much for having me. So the topic today is just trends in venture financings. And this is a really hot topic because one of the questions that we've been getting a lot recently, especially with COVID, is, what's going on out there? Are companies still getting funded? Is capital still available? Can I still grow? And the good answer, not to give away the entire presentation, but the answer is really yes. Capital is out there. Companies are still getting funded. VCs, at least credible VCs, are not pulling deals. They're still funding the best companies. And as we go through the slides, you'll see kind of what's going on with our market activity. And the good answer, of course, is that everything is still getting funded. The best companies out there are able to raise capital and grow and scale. So very, very good news. So just to get started, though, wanted to share a little bit of background on myself, as well as Wilson Sonsini, just for those of you who aren't familiar with what I do, what the firm does. And I'll just take a minute or two to just kind of walk through it. So as Darren said, I'm a corporate securities partner at Wilson, practice with life sciences companies and tech companies exclusively. And my practice really revolves around helping those companies get incorporated, get founded, grow and scale their businesses through multiple rounds of financing. So early friends and family financings, venture capital financings. And then I also work with companies that are at the stage where they're going to go public. And then once they're going to raise capital in the public markets. So I like to scale with my clients from a very, very early stage, from initial incorporation all the way through going public and ultimately exit. As a firm, for those of you who just don't know Wilson, we represent more companies on the company side in the US that receive more venture capital funding than any other firm. We represent more US issuers and initial public offerings than any other firm, and have just a number of public and private clients that we've worked with. But really in the venture capital space, for companies getting funded, we just do more of it than anyone else. My practice is similar to how we kind of look at our business model, where we like to scale companies really and work with them from day one. So that's that first circle with entrepreneurs and startup companies that are looking to raise venture capital. We scale with them all the way through going public. And then ultimately, when they're multi-billion-dollar companies, we continue to work with them. But we're one of the few firms that works with companies from day one all the way through. And we've been very, very successful at it and just find that it's the best way and the best experience for our clients. We're focused, again, exclusively on life sciences and technology, and our offices are in those kind of major market cities that are focused on those areas. Just technology, just life sciences. Some of the clients that we've worked with. So, we incorporated Google, we took them public. We took Apple Computer public on the tech side, Netflix and LinkedIn. On the life sciences side, work with companies like Nuvasive, Fluidigm, Denali. We took Illumina public in San Diego. So we have a lot of life sciences and tech companies that we work with. But you've seen some of the marquee names just by looking at this slide for the clients that we represent and the types of deals and types of transactions that we work on. The other thing that we do, we work helping companies get funded, right? We want our clients to get funded by the best investors that we can. We host investor forums. We're not investment bankers, but we host forums where companies can mix and mingle with venture capitalists. We work with a lot of venture capitalists on deals. They sit on a number of the boards of our companies. And we really view that as an important element to our practice, to the extent that we can make an introduction that's usually very, very helpful to clients of the firm so that they can grow and scale their businesses over time. But just kicking off the presentation, so wanted to talk a little today about venture capital financings, what the process looks like, what different sources of funding may be, how we go about and decide what type of funding is appropriate for companies. And then we'll get into some of those stats that we talked about and really go through what we've seen in the first 2 quarters of this year and why we think the market is still red hot and companies are still getting financed. So with that, I want this presentation to be as interactive as possible. Feel free to post questions and I'll address them either as we go through the presentation or if there's some time available at the end, I'll address them at the end. But one of the first questions that I always get from clients that come into my office is really, what kind of financing should I do? Should I do a note round? Should I do a SAFE? Should I do a Series seed round? Or should I do, a full Series A round? It's very, very common for entrepreneurs to come in and ask that, when they're first getting started in the business. And that's really going to depend on a couple of different questions. It's going to depend, number one, on how much money you're looking to raise, right? So typically, if you're looking to raise a smaller amount of money, that's something that we would see more on a note round, on a SAFE instrument. The other question is really going to be, where is the money coming from? Is it coming from angel investors? Is it coming from VC investors, right? If it's coming from VCs, they may usually write larger checks, and that may lead itself towards an equity round. If it's coming from angel investors, it could run the mix. And then there are some differences in the types of securities. So here, just wanted to go through some of our general thought process when we're having discussions with clients. And really, if you're looking to raise money, if it's somewhere between 50,000 and 200,000, we typically see that on just simple notes. That's founders putting capital into the business early on to grow. That maybe, one friends and family investor that's an accredited investor that's looking to put a limited amount of money in. Anywhere from 200,000 or even frankly a little bit less to 1.5 million, we're probably talking about convertible notes and SAFEs. And we'll go through kind of what some of the typical terms are that are associated with those instruments as we walk through the presentation. And then really over 1.5 million to probably $3 to $5 million, you're talking about a Series seed round, which is a limited rights equity round. And then anywhere typically from 3.5 maybe to $50 million, you're talking about your institutional Series A round. And that's the full set of institutional documents that you would expect. That gives up a number of rights, preferences, and privileges that venture capital investors would typically expect to see in an offering of that magnitude. So that's it. So kicking it off with friends and family. So the first misconception that we sometimes see is what friends and family means. And friends and family really still means you need to be dealing with accredited investors. These are people that are putting money into the business maybe for the first time. They may be relatives. They may be, people that you've had a long-standing relationship with. And they may not be used to taking the types of risks that sophisticated venture capital investors take. So here, they're typically smaller dollar amounts, $50,000. That would be coming in $100,000, maybe $200,000. You want to get this done as cost effectively and as cheaply as possible. And the way to typically accomplish that is with either a promissory note, a simple note, convertible notes, or maybe some type of SAFE. You have to understand that in doing transactions with friends and family, because they don't have that same level of sophistication that angel investors and VCs may have, you've got personal relationships that are at risk. You want to give them a good deal. You want to treat them fairly, but you also want to keep the documents as simple as possible because you're not raising a ton of money and you don't want to complicate things or put yourself in a worse position when you raise money later on. The other misconception that we sometimes see is people expect to be selling common stock to friends and family, and we advise against that. You don't really want to do that. One of the reasons why is because when you sell common stock, it sets the price of the common stock for purposes of your 409A valuation. So it effectively means that when you're issuing options, you've sold stock that's common stock at a higher price than you normally would, and it impacts your ability to issue options at a low price to employees who may be coming on the business early on and that want to get their options at the lowest possible price that the IRS allows. So you typically don't see common stock sales. These are normally structured as a note or some type of SAFE instrument. And just the common stock is pretty unusual. So the next type of instrument that we typically see is a convertible note. And what does this mean? A convertible note is a debt instrument. And the whole purpose of the convertible note is that it's going to convert in your Series seed round, your Series A round, which takes place later on. It's a bridge to get you to that Series seed or Series A round. And what are the terms that we typically see? So things like maturity. You want to set the maturity date out far enough to give you the amount of time you need as a founder of a company to go out and raise a Series C round that's meaningful, to raise a Series A round. So you want to give yourself a year, 2 years, enough time so that you've got some flexibility. In this COVID-related environment, I give yourself a little bit of additional time, just because it can sometimes be tough to schedule in-person meetings with VCs. And usually when VCs are ready to write the check, they want to do an in-person meeting. They want to see you in person. They want to meet some of the founding team. And you want to just give yourself enough time and flexibility to allow it to happen. Convertible notes also have an interest rate. Interest is really not the driving factor here. People don't invest in convertible debt for the interest premium, but they usually do have an interest rate associated with it. And what we typically see in our practice is a 6% interest rate. Convertible notes also have a feature that allows them to, quote, automatically convert upon a qualified financing. So what does that mean? It means if you raise enough money, more money than you put in the note round usually, or at least the amount of money that you put in the note round, sometimes at a certain valuation, that the note automatically converts into the next round. Very, very important, because these investors, you want to have the ability as a company founder to be able to get rid of these notes, and you want to do it on terms with the amount of money coming into the company that it makes sense for these investors to convert as well. So the goal of these notes is really for them to participate in this next Series C round or the next Series A round, but you just don't want to go through the process at this early stage of giving away a bunch of different rights, preferences, and privileges on a very, very small amount of money. So you want these notes to automatically convert into that round. You know, other terms that you've typically heard of and are probably familiar with, things like discounts. Usually for investors to participate in one of these early convertible debt rounds, they need to be incentivized. It's only fair. They need some incentive because they're putting their dollars in before the Series C round, before the Series A round. So they need some additional incentive to do that. And that incentive typically comes from the discount. And what we normally see in our practice is a 20% discount to the next round. So that means if you're selling stock at $1 per share in your Series C round, these investors who have come in early are going to be able to buy that stock at 80 cents. You sometimes also see what are known as valuation caps, and they are effectively a cap on the valuation for the conversion. And just a word of warning here to company founders, you really want the valuation cap to be something reasonable, something that you would actually expect your Series C or Series A round to convert into. It creates all sorts of problems later on if you set your valuation cap exceptionally low. New investors are reluctant to put money in if they're not going to be able to control the next round. So you want to make sure if you're using a valuation cap that it's reasonable. So just keep that in mind. We see sometimes angel investors push for very, very low valuation caps that put companies in a very, very difficult position when they're looking to do their Series C or Series A round. Safe investments. So what are they? A safe is a simple agreement for future equity. And it looks like a convertible note, but it strips out a lot of the debt features. So there's no maturity date, there's no interest. And there's some uncertainty as to where safes kind of fall in the cap table, because in the liquidation waterfall as well. Because the question is really, is it debt? Is it equity? Kind of what is it? And there's still some uncertainty around that, which I think creates at least a preference, at least in the Southern California market, and I think still in the Northern California market, to use convertible debt. So we sometimes see safes, they're popular with Y Combinator, and they're popular with some of the incubators, but typically we still see, as the dominant portion of early stage fundings, convertible notes. They have a lot of the terms that are the same as convertible debt, meaning they have the same type of ability to convert into the next round once you raise a particular amount of money. Sometimes they have change of control premiums, which we sometimes see in convertible debt rounds. So they look very, very similar. They're on short form documents, but still the dominant practice, at least in our market, is to issue convertible debt. Angel investors. So who are they, what are they, and what do they invest in? So angels are groups of investors sometimes, or sometimes individual investors who are former company founders that have the ability to write checks to companies. Sometimes they've sold their last company for a large amount of money. Sometimes they are VCs who have retired from the VC business and now just invest as angels on their own. Sometimes they're wealthy individuals. They may be family offices, but they write checks to help early stage companies get off the ground. Angel investors come in all different shapes, sizes, and flavors. And it's important if you're dealing with angels to do kind of your own diligence on the particular angels that would be working with your company as they're doing diligence on you, right? Some angel investors are absolutely fantastic. They know the business, they can make all sorts of connections, they can lead you to your Series A investor, your Series C investor, they can fund the business along the way. Other angel investors may be bad apples that may be looking to do things that may not be the best for the company. So you really need to do your diligence on them, make sure you're dealing with reputable angels. But when they do come in and invest, typically they invest in convertible debt, they invest in promissory notes, sometimes they invest in safes. They may invest in an early Series seed round, but they usually, unless it's a super angel, don't have the ability to write checks into the Series A, the Series B round, where huge amounts of money may be coming in. So they're great for getting the company off the ground. Do your diligence on who would be coming into the round, but they can be a good source of funding for early stage financings. The next thing are Series seed rounds. And what is a Series seed round? It is a simplified version of a Series A round. So what you're really striving to do here is you're striving to give the investors the key fundamental economic and control rights that they're looking for without all of the additional pages upon pages of registration rights and some of the terms that you would see in a Series A round. So they're scaled down versions of the Series A documents. And what you're trying to do, the goal here is really to give the investors the kind of key fundamental rights, but to keep costs as low as possible with respect to this investment. Right, so sometimes you see no registration rights in. Sometimes anti-dilution rights are included, other times they're not. Sometimes the protective provisions are included, other times they are not. And you usually use a limited set of documents. They do include reps and warranties that you would expect to see. Sometimes they're more limited than the A round. But a couple things that I would tell you here. So first off, when you're at the stage when you're negotiating a term sheet, whether it's with an angel investor, whether it's with a seed investor, no matter what the stage is, you've got to understand that the terms with each of these rounds usually are going to remain flat or get worse. You very, very rarely see equity rounds or note rounds. Once you've negotiated them, the terms get better later on. So it's really, really important here to be working with reputable counsel, to be working with reputable advisors who can help you, because what I hate to see is for companies to come in that have given everything away at the Series seed stage or the note stage, and they set themselves up for terms later on that are going to be really punitive to the company. So you want to make sure when you're doing these initial rounds, when you're doing the initial convertible note round, the initial Series seed round, that you've really got a fair playing field in the beginning. And most angel investors, at least the sophisticated ones, look at it that way and want to do that as well, because they realize that when you get to the later rounds, if you build out really, really unfavorable liquidation waterfalls for the company, when you use really punitive terms on the founders, those terms are going to get piled on top of those early investors later on, because the new investors that are going to come in are going to want rights that are superior to those prior investors. So, sophisticated angels and VCs don't like to have really punitive terms in the early rounds, but you never know. And it's important to be working with reputable counsel to make sure that doesn't take place. So, the sizes, I mentioned this earlier, a typical seed round is probably somewhere in the 1 to 5 million, maybe 1 to 3.5 million range. Usually they're the smaller rounds. Have angels, friends and family, maybe early stage VCs involved. You'd always be selling preferred stock. Preferred stock is stock that has rights, preferences, and privileges that are superior to the common stock. Very, very important, because it keeps a distinction between the value of the preferred stock and the value of the common stock for issuing options. You would be giving up some control in the company. So usually in a Series seed round, you're talking about things like board seats, right? That's a control provision, because that allows investors in those rounds to sit on the board to be able to influence management. You would be giving up things like participation rights. These investors would have the ability to come into later rounds. And you may also be giving up protective provisions. those are effectively negative control, things that you cannot do without an investor's consent. And then, of course, there are economic terms that go along with the Series C round, things like, liquidation preference. These investors get their money back before the common stock gets their money back. And that's a fundamental economic term that goes with any kind of preferred round. And you'd want to see 1x non-participating. And we'll go through kind of what that means just as we talk through some of the Series A terms. So Series A rounds, what are they? We like to save the term Series A for your first institutional round where you're working with a VC partner. There's no set definition of what an A round is or what a seed round is, but we really like to preserve that term for the first institutional round because we think it looks less than optimal if you're going into your Series C round and you've raised, $1.5 million so far. You really want to save probably the A round for that first institutional round. It's very, very important that you get comfortable with the VC that you're going to be working with in this round. These are relationships that you're building. This is somebody who's going to be your partner. It's like a marriage. You want to be comfortable with that person. You want to be able to bounce ideas off of them. You want them to be helpful. You don't want to have a hostile working relationship. You should interview other portfolio companies that they work with and really want to make sure that this is the right fit for your company. Because the VC that comes on board in the A round is likely going to be involved in the business for many, many rounds to come. You'd hope that they would have the ability to help finance some of those additional rounds. And you'd want the relationship with that person just to be as good as possible. So key parts of a Series A term sheet, at a very, very high level, the terms that matter in a Series A financing, a Series C financing, or other financings are terms that impact, number one, the economics of a transaction. How much money as the founding team am I going to get upon a sale? And terms that impact the control rights. Am I going to be able to control the board of directors? Are the VCs going to have blocking rights over different types of transactions that may occur going forward? So those are the key buckets of terms that we look at when we're looking at term sheets. And just to walk through some of these terms at a high level, valuation is the most fundamental term on the economic side that gets negotiated. What's the valuation of the round? VCs speak of valuation in two ways. They speak of the pre-money valuation, which is the valuation before the financing, and the post-money valuation, which is the valuation after the financing. And at a very, very high level, without complicating things with like notes and safes and other things, if you look at a pre-money valuation and you say, I want to do a deal at a $15 million pre-money valuation, and I want to raise, say, $5 million. You can get to the post-money valuation by taking that pre-money valuation of $15 million, adding in the amount of money that the VCs are going to invest in the round, the $5 million, and getting to the $20 million post-money valuation. So at a high level, that's how it works. Option pools. Here, the option pool is really an economic term because the VCs will force you as a founder of the company to take the option pool in the pre-money. It means the dilution that's associated with the option pool that exists today and any increase in the option pool that the VC thinks is associated will be allocated just to the founders. So all of that additional dilution is borne by the founding team. So you want to come armed to negotiations with VCs with an option budget. What do I need to get my business off the ground and running? How many new employees am I going to need? How many consultants am I going to need? And how much equity is going to be allocated to each of those people? You should be prepared to do that before you go into a meeting with a VC. It's very, very important because they will try to force the company to take a larger option pool than you may otherwise need. Dividends for early stage companies, dividends are really not the most important thing, at least in West Coast venture capital financings. VCs don't invest for a 5% return, a 6% return. They invest for a 10x return, a 15x return, a 20x return, right? The dividends in early stage financings just aren't going to juice the deal enough. They're not important enough, and you typically see these as non-cumulative. If you do see a term sheet from a VC in a West Coast venture capital financing that has cumulative dividends, especially for an early stage financing, that's a problem. And the reason why it's a problem is because if you're raising $1 million and you've got a 6% dividend in there, that's $60,000 of liquidation preference that's going to get added every year. Not a big deal. But when you go to raise $100 million, that suddenly becomes $6 million a year in liquidation preference that's going to sit on top of the founders. So very, very important to kind of get those terms out of an early stage financing. Liquidation preference, we've chatted about this a little already. Liquidation preference really is the investor's ability to get their money back. And what we typically see in early stage companies is a liquidation preference of 1x that's non-participating. If you're seeing something other than that, it's really important that you have a serious discussion with your counsel and with your advisors, because that's going to be a problem later on. Anti-dilution, this is not something that's heavily negotiated. In 99% of our deals, there's broad-based weighted average anti-dilution. And I won't bore you with the details on how you calculate that, but it's just not something that, that comes up in a number of our deals. What it doesn't mean, though, is that you get to hold your percentage of the company forever. It means effectively that if you sell stock at a price per share below the Series A price in the next round, that there's going to be some adjustment. Board composition. So this is a key control term because the board hires the management team, makes decisions about salaries, and runs the business, at least oversees the business from day to day. They have the ability to appoint the CEO, to appoint the officers, and frankly, to remove the officers if they see fit. So, you know, the typical board breakdown that we see at the time of a Series A financing is 2 founder designees, 2 investor designees, and maybe 1 independent. If you do better than that, you know, you're really in a good position. And most of our companies, you know, typically either get that kind of standard, or sometimes the VCs control the board. It's really, you know, how much leverage you have time going into, how much leverage you have going into that financing and that discussion. Sometimes one of those seats is tied to the CEO continuing to be the CEO. And what that means is if the CEO is no longer the CEO of the company, they also lose their board seat. So things just to think about when you're negotiating the term sheet. Founder vesting. So it's very, very important that all founders be on vesting from day one, because you don't want to have a founder free riding problem where they can leave the company. But VCs also like to impose vesting on founders, and sometimes they like to restart vesting. Typical founder vesting is 4 years with a 1-year cliff. And for companies that we work with, we like to put that in place from day one, so that at the time of financing, a VC is more likely to accept that. And then there are drag along provisions that sometimes get negotiated, and protective provisions as well. So we've spoken about liquidation preference at a very, very high level. You know, what is it, how it works. I'll go through kind of one example of what this looks like and why participating liquidation preference is just not optimal. But it effectively means, as we discussed earlier, that the investors get their money back before any money goes out to the common stock. So I'll let you study this offline, but I'll just walk through at a high level what this means. So if you look at the middle column here, this is fully participating preferred. And what it assumes is that the investors have invested in the Series C round and the Series A round a cumulative $6 million. So there's $6 million of liquidation preference here. And if that liquidation preference is fully participating, what it means is off the $30 million sale price, you take the first $6 million and you give it to the preferred stock. Then the preferred stock gets to double dip again, and they get to participate fully with the remainder of the distribution. So the remaining 24 million gets allocated among the Series C investors, the Series A investors, the common, you know, and the option pool that's outstanding. And if you look at this, the key thing to look at is, because we've got a fully participating preferred stock, the amount of money that gets allocated to the common stock, the founders in this example, is $11.2 million. If you've got non-participating preferred, which is what we see in most of our transactions, it means the VCs have a choice. They can either elect to get their money back, which they would elect in a downside scenario, or if they would get more money by participating with the common stock, they elect to convert to common. So here, because they would get more money by participating with the common stock, the VCs have elected to participate with the common. And it's very, very important, because if you look at the distribution to the common stock here, instead of it being 11.2 million, it's $14 million. So when you see terms like this, participating preferred or non-participating preferred, those terms really impact the economic rights of the founders and how much money they get upon an exit. So other things, you know, we chatted about anti-dilution protection. I'm not going to spend a lot of time there. Just know that broad-based weighted average is what we see in the majority of deals. And other things, control. So control is very, very important to our founders. They want to make sure, to the extent that they can, they've got control at the board level, that they're controlling, decisions of the company at the board level. You sometimes see that if you've got a founder that's got an awful lot of leverage, maybe somebody that sold their company for millions of dollars before. But typically you see that structure that I discussed earlier with the 2 founder representatives, the 2 investor representatives, and the industry expert. And then you've also got to pay attention to what are called protected provisions or blocking rights. And these are things like, VCs may want, and these are common, blocks on a sale of the company. You can't sell the company without getting their consent. You can't amend the charter without their consent. You'd need to do that if you were going to do a subsequent financing. You can't issue senior equity securities. Sometimes you can't issue debt over a certain size, or you can't increase the option pool. These are common blocking rights that we would see in connection with the preferred stock financing. So just to give you a sense of useful tools and resources, we put out what's known as a term sheet generator. You can play around with it. It's helpful to get a sense of what different terms look like. Ultimately, I wouldn't use it in a VC financing, but it's helpful to get a sense of what different terms actually look like when they go on the term sheet. We've got one for a Series A financing. We've got one for a convertible note financing. It's a free tool, and it's available on our website. The other thing that we publish, which is really, really helpful for founders of companies, is we publish an entrepreneur's report every quarter that's got our deal data and what we're seeing in the marketplace. And it's got all sorts of terms and conditions. It's got what we're seeing in bridge loans, what the typical terms are. It's got the percentage of up rounds where deals are being sold at a higher price than the last round. Percentage of down rounds where deals are at a lower price. It's got typical terms that we're seeing that are being negotiated in Series C and Series A financings, and it's got valuations. So very, very helpful. And just some of those terms that I pulled from the report to use today. So what are we seeing? What has Wilson been seeing in Q1 and Q2, since the start of COVID? And what we're seeing is, up rounds are still at an all-time high. I mean, they're very, very high. The number of up rounds that are getting done, which means the price per share is above previous rounds, is 80, 90%. If we looked back at the last recession, if we look back at 2009, 2010, that shifted down to maybe 50, 60%. So we're still seeing a very, very good market for financings. The down rounds have trended down in Q2, and they continue to trend down based on what we're seeing in Q3. So it's still a very, very good market for company founders, and it's something that you should be excited about. You can still go out there and raise capital. What are we seeing just in terms of valuations? So valuations look terrific. In Q2, the Series C median pre-money valuation was $12 million. That is the highest level that it's been since 2015. We're seeing great valuations at the Series A round, 33 million pre-money valuations. And the later rounds are at very, very, very high valuations. Now, of course, this is based on Wilson's deal data, and we do some of the mega deals. So when you look at the Series C and later rounds, some of those are companies that are unicorns, that are very, very late stage companies that have raised billions of dollars. So the Series C data may be a little bit skewed, but we're seeing great valuations at the early stages in the Series C and Series A rounds as well. Amounts raised, we're still seeing companies raise good amounts of money in these rounds. In Q2, raising on average 2.8 million in a seed round and 9 million in an A round. So we're still seeing very, very good ability to raise capital, and we're not seeing deal sizes fall apart. Bridge loans. So for pre-seed, this is early stage bridge loans. Companies are raising. What we're seeing in the latest deal data. Roughly $800,000 or a little less than $1 million. And the post-seed bridge rounds are obviously larger. Those are bridges between a Series A and a Series B round. But we're still seeing good amounts of money raised on bridge loans, and those are the convertible note rounds that I discussed earlier in the presentation. So that's it from me. My contact information is here. I'd be happy to chat with any of you that are maybe negotiating with VCs that are looking to raise money.
I just wanted to thank you. That was a lot of great information there. And in fact, I think the last 3 or 4 slides were some great information. I think it's good to see it makes me optimistic, I think, for the community to see how much is coming in. It does feel like, if you're around the industry for a long time, it feels like all the stages what's called a seed is now kind of almost what used to be maybe a Series A. And now we have this pre-seed concept that's come in. And so it feels like everything kind of has shifted up a little bit. What is that an accurate observation?
I think you're 100% correct. Yeah, yeah. So it used to be that you would jump straight to the Series A, and now we've got the Series Seed round, which is really probably the old Series A that's taken its place, because the A rounds have just gotten so much larger. So that's an accurate observation and a really good point on your end.
And then, the other thing too is I think all the information that you just provided, and then when you listen to the questions and the answers, and I think that today we've had a lot of interesting answers come in from the great questions from the VCs. And I think that shows, demonstrates, I think, the need to really understand the kind of like the importance of the information that you just shared, which is that there's all these different options and directions of ways to go and the way you can finance something. It's not just one answer. And that's the value of having conversations with someone like yourself early on in the process so that you don't make the mistakes. And it's not even necessarily a mistake. You wouldn't know it was a mistake until later on when something else happens where you realize, oh, I wish that I had done this differently because I need to pivot. And suddenly I can't pivot. And if coronavirus has taught us anything, we all need to learn how to pivot.
Yeah, agreed.
Well, thank you so much.
Yeah, no problem.